Okay, good afternoon, everybody. Welcome to the weekly take on the market. I will be your host. My name is Scott St. Clair. I am the manager of the Premium Product Group here at IBD. Here's the disclaimer. We are not licensed. We don't make buy, sell, hold recommendations. Take a moment to read this. So we will go through the markets, then we'll do the industry groups, some stocks that are on my radar, and then we will do the quote of the week. So let's pull up MarketSmith. And you should see a daily chart of the Nasdaq composite. It is 1:15 Pacific time. So this price should be up to date. The volume will be a little bit behind. So don't read too much into it. I don't know if today was a big volume day or not. When you're in a market in correction, and it doesn't really matter. I am reading the tea leaves a little bit, but bottom line is the market's acting very poorly. So it's not as relevant whether it's a distribution day, so to speak. So you're below all the moving averages. I've got the relative strength line tagged to the Nasdaq, so that's why that's a straight line. So if you don't see that, that's because I've changed my relative strength line. But we're below all the moving averages. The red is going down. Eventually, this will start to go down. And this is just going to be a ceiling for any type of rally, at least for a while. You have the nice tail here, which gave a lot of people hope. You have a tail here. I think you could get it, to get some kind of rally, you probably need 3 waves down. And Justin sent me an email. Justin Nielsen at IBD was this 3 waves down? I guess it could be. I think I calculated this wave as 8%. Not really a lot, but 8% down. I think this was 17 and this was 13. I would have preferred that they stacked on each other. So 8, 17, 24, that would be better, I think, because it would get more extreme. That's just, how I would look at it. But I really honestly think this is the 1 wave down right there. And, if you've ever heard of Elliott Wave or done anything with Elliott Wave, one of my knocks on Elliott Wave was you've got waves within waves. So I had a friend when I first got in the business was used Elliott Wave all the time, but he would always say, the daily is on a wave 3, but the monthly's on a wave 1. And it was just too confusing for me. So, if this goes really low and you have some kind of, really major bear markets, you'll know, oh, this was the first wave down. It's always easier in hindsight, but I think you need more than 8% is my gut feeling for this to be considered a wave down. So I really believe this is the first wave, and then the rallies back should be really strong based on bear market rallies if it's part of a 2 or 3 waves down. And 13,094 to 14,509. I guess I should have done that before, but what's that, 9% or something? Let's see if I was close. 10 and change. So it's pretty good rally. So I think this is the first wave, and this could be the second wave low, although the jury is still out. It's not the markets are just not acting well. There's just a lot of overhang. Let's look at the S&P. Oops, I don't know why that slides out like that. Same thing. 1, maybe 2. Holding up so much better. And this is, look at the RS line on the S&P. Because I'm using the Nasdaq, it's at 52-week highs. And I've talked about 100 times, why is the S&P so much stronger? Well, because there's energy in the S&P. I guess I don't know exactly what stocks on the energy side are in the S&P, but I know the Nasdaq doesn't have any of them. And, the mining stocks, Rio, Fremont, FCX, all showing major relative strength. I don't know if Rio is in the S&P, but I'm pretty certain FCX is, but you get the idea. So there's stuff in the S&P that is performing that's outweighing the stuff that's going down. Whereas in the Nasdaq, it almost has none of that. It's just all besides Apple, Google. What's left? Apple, Google, even Amazon seems broken. I think it's, yeah, it doesn't look very good. I think Google and Apple are really, and even Google's at the 40-week line, but it is an RS of 81, and Apple is just above with an RS of 91. They're really holding the indexes up, and Tesla maybe a little bit is acting okay. Nvidia, it's not acting terrible. It's 33% off its high, and if you own it, that hurts a little bit. But compared relative to other stocks, it's not doing too bad. Emerging markets. I haven't looked at EM. Oh, yeah, no surprise. New low. There's just no place to hide. So one thing about bear markets is it's he who loses the least wins. So you want to just try to survive so that you have capital left over for the next wave up. Mental capital as well. You can get worn out pretty good in a long drawn out bear market. And this is really, I know it's early on, but this is how many weeks off the high are we on the S&P? 2, 4, 6, let's say 8 or 9. And how many weeks are we off on the Nasdaq? 2, 4, 6, 8, 10, 12, 14, 15 weeks. So I mean, even the COVID one was 1, 2, 3, 4, 5, 6, 7, 8. Before you had a follow through day, but before you made a new high, it was 2, 4, 6, 8, 10, 12, about 15 weeks. We're not making a new high on week 15 in the Nasdaq if I counted that incorrectly. Oh, nor week 16, nor week 17. So this one has some ways to go. Russell, I guess. The indexes are just not that good. And the funny thing is bonds, which might be a place normally that people would hide. The TLT, which is the proxy, is down 10%. I'm pretty certain that the TLT is or bonds are down this year. I think I saw it was very few years where both bonds and stocks finished down. Now it's only March 4th. Anything can happen. We found out in 2020. But so far, there's just been no place to hide. I guess, gold to me looks very good, but it is gold. It's just so tough, but it looks like it's coming out of a long base. On the weekly, you can see this really long flat base. And, here's the first news of the Russia-Ukraine conflict. That was a pretty nasty bar. And, I actually sold because of that bar, but it just kept what a friend of mine calls this. He calls this chewing the tail. So if you get, if you break down and then you start to go through these prices, it's really positive action. He calls it chewing the tail from like the opposite way. So if this was the opposite way, if the stock, broke down and then started to come back, eating through these prices, so to speak, that'd be pretty bullish when you get a really bad tail like that. So this action is pretty strong to me. I don't know how, some people, how they feel about gold. To me, it's, I don't want to just say it's just 4 letters, but there's a little bit of that. I'm a big, most of my analysis just goes into the price. If the price is going up, if it's acting well, if there's liquidity, if I think I can, set up some kind of risk reward trade, then I'm not worried so much. I'd rather buy, Apple, Google, Facebook, quality companies coming out of a base like this, but this is what you're given, and you either, pass or do nothing. There was, what was that ticker? Oh gosh, maybe I have it on my screen here. Oh man, I wish I could remember it. But there was a commodity ETF that looked really strong. Yeah, this one, DBC. I wish I had seen this or known about this. Look at that. And so it's got everything. It's got oil, gold, softs, ags, and and so you've got all of it. So it's super diverse in that area, and it's not, it's not going to make big moves, but gosh, today it was up $1, and I almost bought it here because of that same concept. It has a little tail here, and going up, but because I owned gold and some other mining stocks, I felt like I had enough exposure. But this area is really outperforming. It's incredible relative strength in this area so far. All right, let's go back to slideshow. So we had a 5% intraday reversal. I think the Nasdaq was down 2 and change and closed up 3. On the news and on that tail that I talked about. And honestly, it's great that happened, but it's not good action. It's historically bear market action. Now it's not, you've only got 3 data points here in the last 20 years, but there haven't been that many bear markets in the last 20 years. And so this chart was interesting to me. So when you start to see that kind of heightened volatility, it's just chewing you up. It's the people that are short. If you're short and the Nasdaq opens down 2% and closes up 3, you just got buried. And if you're long, it's hard to be long. You don't have any conviction to have any kind of size. So this was the first instance of that. Let's see if we have a handful more of these kind of red bars as we go through this. This is good news. The investor sentiment is finally capitulated. You have more bears than bulls. Historically, it's one of my favorite indicators for sentiment. So keep that in mind, which is one of the reasons why I'm only lightly short. I feel like it's long in the tooth. I don't have any idea on the geopolitical thing, on when or if this conflict will ever end. But if there was a ceasefire, or if it somehow stopped, you wouldn't want to be short, at least for the opening or a number of days. So if you're pressing the envelope on the short side, you obviously have to be thinking about that. I have a single stock short, and it will be up if that happens, and I'm okay with that because I have other stuff that hopefully will be up as well. But the bear market is becoming more and more obvious. I think we've been in the bear market for a long time, and I'll show you some stocks that just signify that the market's been broken for a while. But it's becoming obvious to people, which is good news for hopefully the end eventually. Here's a chart of Nasdaq rallies and the length of the rally after the 2000 top, so you can see what you're in store for. Possibly, and long bear markets are tough, but there's some amazing rallies. So if you're nimble, these are tempting is the right word, because gosh, 41% in 36 days, 20% in 21 days, 43% in 33 days. Those are really tempting to try to catch a piece of. So I know that then a lot of people out there will be trying that. But remember, every one of these rallies failed, right? Because the Nasdaq went on to make new lows, 51% in 75 days. But you could get a lot of counter trend rallies in a potential bad bear market. Now, 2000, and at least in my trading window of 25 years, is extreme. 07 was bad, obviously. The thing about like 07 was the types of companies that went down versus 2000. I don't know, maybe because I was younger, it didn't bother me as much in 2000, because a lot of those stocks I felt like they just weren't quality companies. They were coming public with eyeballs, or we're selling at a loss and making it up on volume was the running joke, right? So you had a lot of stocks get hit really hard and never come back. So, and a lot of the stocks in this market environment are not going to come back. They are not. They're going to go away. They're going to go away of the dodo bird. Interesting ARKK comparison. Now this is April 6th of 2020. Why did I pick that date? That was the start of the, for lack of a better term, the COVID bull market. That was the follow through day on the Nasdaq. And you can see ARK just went bonkers in that uptrend. And here's Berkshire, did nothing really. It went up, but vast chasm, alligator jaws of underperformance. And you have to be wary when you see this. It doesn't mean it has to stop. Here's kind of alligator jaws, and it got even worse. But you have to kind of know these types of extremes don't last forever. And now you're back to where if you bought Berkshire on that day, or you outperformed ARK. You'd rather have been in Berkshire. If you don't have a sell strategy, I think you'd rather have been in Berkshire. If you're just going to sit and hodl and do nothing and own stocks for the long run, this mentally, I think, even though, and also obviously because it's higher, more money, but just much easier to handle, right? Whereas this would be really, really difficult to handle because you'd have the extremes to the high end, and now the extremes to the low end. So keep that in mind as far as, if you're investing for the long run. I'm investing for the long run. I will do this until the end for me. But I don't know. I'm just sold that you have to have a sell strategy if you're going to buy individual stocks. Now, ARK is an ETF, but it's not a broadly diversified ETF. So to me, you have to have a sell strategy. You want to buy the S&P, you want to buy the Nasdaq, you want to buy emerging markets because you think someday they'll come back. That's fine. You just keep buying them and buying them because they're broadly diversified. Like Russia, some of these Russia ETFs have stopped trading, and they might not ever trade again. I don't know, but if I owned one of those, I'd just write it off to zero. I'd assume it's just a zero. It's not coming back. And because even though it's ETF, it's not broadly diversified, right? So you have to have a sell strategy. I know it's hard if you because we all want to sell it at the top, but you're never going to get the top. Forget about that. All right, let's pull up the industry groups. And again, I don't think we're going to spend a lot of time on this. Oops, sorry. I haven't looked at it in a few days, but I'm pretty certain it's going to be exactly the same that we all expect and know. All right, international, Canadian, energy, coal, drilling, exploration, integrated, so on. Chem Ags, I messed that trade up with CF. NTR is acting great. They're getting a little climactic. I would definitely be selling them if I had them now. Unfortunately, I don't have them to sell them. I won't be shorting them, that's for sure. But they look pretty climactic. Maybe we can pull those up. Mining, metal ores, acting good. Oil and gas refinery, etc. So, usual suspects. All right, yeah, so I'm going to leave it at that. I just don't see a whole lot to do there. I think you guys know. Let's look at some of the stocks. So CF. And so if I were to draw like a upper channel line, you can see it's starting to peek its head out of that. And it's not only just peaking, but really starting to go. So you're overthrowing that channel line. It might do it for another week. I don't think it'd go up that much, but my experience is they'll overthrow and then they'll come back in. NTR. So, but remember, I always sell too soon. So keep that in mind if, based on this factor, but they look a little bit, climactic. They're really pushing. Now NTR is, in the green zone on this base, and from a weekly standpoint, really pushing, but they're the leadership. Mosaic, not as good a trend line, honestly, but same thing. Let's talk about stocks and why you have to have a sell strategy. This is Bumble. I don't know why it came up on my screen or Twitter feed or something, but game over. And when they write the book, about this time period that we went through, the bull market. And the nice thing about books is they come out a lot faster nowadays. There was a book called Bull by I'm looking at it right now. Maggie Mahar. My eyes are so bad. Mahar. I'm pretty certain is her name, but the title is Bull, Bull, and she wrote about the 2000 the 90s bull market into the bear. So if you didn't live through that, I highly recommend you read that book and, you know, the history of that. But this had all the trappings. You know, I'm not on these dating apps. I've been married for forever, so I've never used a dating app, but I don't know how Bumble is any better than Tinder, which is any better than Match. And so when they go public at, you know, multi-billion-dollar valuations, and the CEO, the young lady that created this company, it was the youngest female self-made billionaire in the history of the world, I think, at the time. I remember her ringing the bell at the NYSE, and awesome, kudos to her. And even at this price, I'm sure she's done super well. But you know, when you start to get these records for companies going public with, you know, no earnings and minimal sales, you know, the little alarm bells start to go off in your head when you've studied history. And that's what one of the things I wanted to say about what Bill talks about in history. This is a great quote from Bill. He says, "We are historians, studying and discovering how stocks and markets actually work," right? That's what he does. How do stocks and markets actually work? And this is not unusual. The Bumbles of the world, I lived through it in 2000. Lots of companies going public with, you know, no earnings, very little sales, if any. Back then, sometimes not even that, and extreme valuations. And it's all kind of come crashing down, and Bumble's not the only one. There's plenty of others. The whole SPAC thing has come and gone. This was the stock that I owned. A friend of mine told me how great the new way that they're going to create fruits and vegetables was, and you know, it sounded like the narrative was awesome. The story was great. I even was researching where the company was located, thinking that, you know, if they're gonna revolutionize the food industry, they're gonna need a lot of land, and people are gonna need to live there. And I bet it's land and the houses are cheap there. You know, I literally did that. Like, I was thinking, like, maybe I had to be buying a house there as like a second investment on a rental property, right? So when I catch myself thinking that, I know that I'm outside my comfort zone and my knowledge zone, and so it just reeks of you know, something terrible happening. So go back, study history, be a student of history. This happens over and over, and if you got hurt this time, then you'll be protected next time. Some stock. What other stocks did I want? Oh, I want to talk about MU. This is the problem with bear markets. So MU looked really good here. I actually almost bought it. In fact, this day I was going to buy MU if it had gone blue. If it had been up, I would have bought that stock. You know, if it had exceeded that pivot not pivot, but that price any part of the day. It opened down, never went blue, and then today just got torched. And that's what happens in bear markets. They set you up to make you think that they're going higher, and then they don't. Here's Globant. I bought that one right there and had to sell it 2 days later on that, you know, really nasty reversal. Luckily I did, because it gave it all back. Suave has not done that. And so far it's acting really good. And if the market was good, if things changed, you know, I've got a go-to name. I like the way this is setting up. It looks like a double bottom, but I'm afraid to buy because of, you know, the fact that this tends to happen like that. Palo Alto, not so bad, but if you paid the pivot, if you were late, you're getting underwater. You're down 3%. Solar Edge, right? Big day, and now you've given back, 75% of the day, not of that move so far. And that's the problem with these types of markets. They're going to suck you in with good price action, and then just get you on the other end. So you have to keep that in mind. Stocks that look good, Rio. Although it gapped down today, I kind of had a feeling that was coming because it was up 1, 2, 3, 4, 5 days in a row and just acting really good. But that one's just coming out of a base. Look at the weekly chart; looks very good. The relative strength is good. I don't know if this is a consistent dividend that they pay. I don't buy them for that, but if you somehow were able to survive, you can capture the dividend. FCX really looks super strong to me. I mean, remember my relative strength is versus the Nasdaq, but wow, look at that relative strength line. It's coming out of this really long base. And today, the market was down. The futures in Nasdaq was down 1.5%. The S&P was down 0.85, and the stock was up. It never put any pressure on me. I think it opened down 20 cents or something. So you should be looking for that type of unusual strength so that you have places to go if something were to really change. All right, so let's go to the quote of the week. It's from Market Wizards, I think. Oops, hopefully nobody sees my typo. Market Wixards. I apologize for that. But Jack Swagger is the author. 2 weeks ago, you're very bearish. What made you change your mind? Paul Tudor Jones says the market didn't go down. How simple, right? The first thing I do is put my ear to the railroad tracks. When I trade, I don't just use a price stop. I also use a time stop. If I think a market should break and it doesn't, I will often get out even if I am not losing any money. And that's how I trade. Right or wrong, this is one of the first books I grew up on, and that made so much sense to me. So I don't use a time stop where I say, oh, I'm going to hold this stock for 3 days. If I'm not up 3 days, I'm getting out. I don't have a hard rule. I wish I did. I wish I could categorize and give myself hard and fast rules. I think it'd be a little easier on myself. But I do have a rule that, I'm using some type of time stop, like with Globant. If it didn't work after 2 or 3 days, I might just get out of it, even though I'm not down on it. So something to keep in mind. But you'll know when the market's finally ready to go, I think, because it'll just stop going down. That's the first clue. It's just not going to go down any longer. And we're just not there yet, right? Obviously. And then I wanted to put in a quote from Van K. Tharp. He passed away this week. One of the great teachers of psychology of trading. He's in Market Wizards as well. He's the last the last chapter interview in that book. And I've studied his stuff, and I have a couple of his books. So I was sad to see he passed away. But he had a great rule I liked, or a great quote. Speaking of rules, a mistake is when you don't follow your rules. If you don't have any rules in trading, everything you do is a mistake. And one of Bill's favorite things to say all the time at seminars, live events, was rules, 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 right? He would always say that, if this, then that, if this, then that. So you want to have some rules. That's why having a stop loss rule of 7 to 8% is good. It's not the ideal stop. It's not a what's the right kind of way to phrase it? I think every single stock probably has more of a better threshold of a stop based on its volatility, based on the liquidity, rather than some arbitrary number of 7 to 8%. But it's better than nothing. That's why Bill had created these rules. He wanted to give people rules to help them follow. It'll keep you out of trouble. So, have some rules, position size rules, how many stocks you'll own rules, where you'll get out, where you'll take profits. and try to follow those rules as best you can. You'll be better off for it in the long haul. It's like anything. It's not gonna work the right way every time, but over a number of observations. All right, thanks for your patience. I think this one ran pretty long, but I felt like I didn't do one last week, and there's, the market, there's so much to think about and discuss. Reach us at marcusmith.com, 800-831-2525. Have a great weekend, everybody. Bye-bye.